right, so here we are. We are at the all-time high market once again. You have money sitting on the sideline and you don't know what to do for 2024. On one side, you are comfortable because you're making that 5% yield on a high interest savings account or in some bonds or money market funds. And then you're thinking, well, I might as well just stay there and not invest because the market's gonna crash, right? This is what you may be thinking. I have some bad news for you though. The market is likely going to do whatever it wants, but the interest rates are likely going to decrease in 24. So that means that your high savings account are likely not going to generate that same 5% for the next 5 years. That is unlikely to happen. So are we afraid and why are you sitting on the sideline at this point? You're sitting at the sideline because you don't want to start investing right before the bubble crashes. What you see there is exactly what happened for investors that started to invest in 2008, right before the financial crisis. On the upper part, you see the S&P 500 total return. That did in 5 years about 8%. So you cannot really retire on 1.5% return a year, right? And you see that there was a long moment before you even see $1 that is positive. So if you're about to invest your hard-earned money that is right now very comfortable in a high savings account, you don't want to do that. If you're Canadian, it's even worse because for that 5 years period, you would be up 4%. It's not even enough to compensate for the inflation. So what are you going to do if you're sitting at this point? The logical answer would be to wait until things get clearer, right? So here's a slide that I like to use during my presentation to explain how waiting is a losing game. So I went back in time just up to 2015, but actually I could have gone to all the way the first year that I started investing in 2003 and give you some pretty solid reason not to invest. So in 2015, nothing worked, not bonds, not gold, not equity. So it was one of the hardest year to make money on the market. So everything was pretty much flat. In 2016, we had the chatters that the UK wanted to exit the Eurozone. That was a big news, the market dropped, and now we started to feel more pressure in our investment. In 2017, the market was trading at an all-time high and we had the Hindenburg omen. So this is a set of technical signals telling you a market crash is about to happen. Well, we kind of got it in 2018. So the second part of the year, so between roughly June, July, all the way down to December, the market was down roughly 20% from its peak level. So we already had a small bear market and it was the worst year to invest since the crisis of 2008. In 2019, everybody expected that this bear market would continue, but then boom, it was actually the best year in the past 10 years. So that's kind of like created even more confusion. We're not too sure how to enter into 2020. And then, well, we got a Great Depression and a great revival in the roaring 20s and name it, everything happened during 2020. Followed up after that with 2021 with party time where there was meme stocks, crypto, and everybody was making money. Everybody was a genius. And then boom, we got 2022 where now it's like, oh, we have inflation, we have higher interest rate, and people are struggling and we're all going to end up into bankruptcy. So the market went back down and then we entered 2023 thinking, yeah, that's going to be just a continuation because we will continue to suffer from high interest rate. Inflation is still not under control. We do have wars happening. Political tensions are at its peak. That's definitely not the right time to invest. And now you wake up in 2024 at the beginning of this year and you wonder, okay, but right now inflation is about to be under control. Interest rate still high. War still there. Like companies trades at an all-time high, so definitely overpriced. And then you're going to be saying, well, I'm going to wait a little bit, right? Because I know that this year is not going to be a good one. Pretty much the case where 2015, 16, 18, 19, 20, 21, 22, 23 was exactly what happened, right? So let's take a look at what happened really on the market during those years. Well, big surprise. the market went up. So yes, of course, there were like volatilities, ups and downs. It was not an easy ride. But if you have skipped and decided to wait in 2015, today you kiss goodbye some of like the best years in the stock market for over the past few decades. So that was just a perfect timing to invest while the market was constantly overvalued, while there was a lot of problems in Europe, while there was a lot of political tension between the US and China, while we had COVID, we had a bunch of stuff, and yet it was still a great time to invest. So now back to your question. Okay, so Mike, I get that I should invest my lump sum of money because waiting on the sideline is not a good thing. I get with the past videos that you sent me that I now have kind of like a good buy list that I've built on US or Canadian stocks, so you can watch previous videos for that. And I get how I can play around with stock screener and sector allocation to make sure that my portfolio would be well diversified, generating a decent yield, but mostly focused on dividend growth, so I buy quality companies. So you get all that, so that's great. But still, there is the huge risk of investing today and then seeing 2024 being like down 25, 30, 40% because it's the year of the crash. You certainly don't want to invest all your money today, right? So I have a solution for you. So going back in time to show you how I would approach that, imagine that you have that money right before the market crash of 2008. So right before everything goes wrong, you just get your money and just like, yeah, it's about time that I invest, right? So you don't want to put everything in one place at the same time, right? So here's how you can do that. You have your buy list, you have your portfolio model, you're ready to pull the trigger. So what you can do now is you can invest 1/3 of your portfolio of the money that you have sitting on the sideline right now. So you invest, you create your portfolio with roughly 30, 33% of your liquidity. And now you wait a full quarter, so 3-4 months, the time that you get more economic data on inflation, on the economy, for unemployment rate, for interest rate, and also review each of the companies that you have in your portfolio. You can review their quarterly earnings, making sure that everything is still making sense, still according to your investment thesis, the numbers are still strong, the dividend triangle is still strong, and then you can deploy another 1/3 of your portfolio liquidity. So 30, 33% again. So now you're up to roughly 60, 66% of your portfolio invested in the market after 3-4 months. What do? You wait another quarter, so another 3-4 months to get, again, the same quarterly earnings, the same unemployment rate, inflation, interest rate information, economic data that you're looking for, just to make sure it still makes sense. What happens after that? Well, you invest the rest of your market, of your liquidity. The way that you do that is it will spread your money across roughly 6, 7, maybe 8 months by the time that you're fully done investing. Well, when you look at the stock market here, that took 9 months between the peak of the market and the perfect bottom that was March 2009. However, if you had invested everything between July and November, you would have pretty much catch all the drop. So the message here is if you are able to invest for the next 6 to 9 months, if the market crash happens tomorrow morning, you will average down and you will eventually catch pretty much the bottom of the market. So after that, it will take a while before it goes back up, as we saw in the first slide of this video, where it can take 3, 4, 5 years sometimes to go back up, but you did some DCA, so you have catch a part of that bottom and now you're ready to go back up. So that strategy enables you to avoid a good part of a market crash if it happens tomorrow morning. If it doesn't happen in 2024, well then you still have the same technique where you're buying gradually as the year goes by and you grow in confidence, and now you're getting more dividend, more investment working for you, and you can still sleep well at night if it was a good year. So this is how I would approach how to invest in a lump sum payment in 2024. Do not sit on the sideline forever, because every year will come with more dilemmas, with more doubts, with more fears, and you will get paralyzed by analysis. If you want to know more about how to set up your portfolio, if you want to have a full market review, more ideas, stock list, and the most important teams on how to set up your portfolio for 2024, I do have a webinar next week on Wednesday, January the 10th at 1 p.m. Eastern Time. You can register for free right there. You just put your name, your email address, and if you cannot make to the live event, don't worry, I'm going to send you the replay. So it's not going to be available on YouTube. You have to register to get the replay, but it's 100% free. There's no string attached, and I will provide you with my playbook for 2024 along with answering all your questions during the webinar. So all right, guys, don't forget to give me a thumbs up, to subscribe to the channel, and turn on the notification to not miss the next video that will now this time happen on next Thursday. And in the meantime, don't forget to stay invested.